Ray Dalio recently released an interview where he spoke about the realities of investing in this current financial environment where we find interest rates nearing zero. The first question in this new interview released June 19th is an important one for the future of this country and the long-term future of the stock market. Dalio takes about 2 minutes to answer. I wanted to show you the full clip because I do believe it's an important message, a message that frames the truth about investing in 2020 and beyond.
Zero bound for quite a while since the global financial crisis. But the policy that central banks used to ease more than a decade ago was just the printing of money to buy financial assets. In the aftermath of the pandemic, we find ourselves once again dealing with the constraints of traditional monetary policy. So my question to you is, what will easing look like now that interest rates are already low and central bankers have spent a decade buying assets and pushing down risk premiums?
What you find in studying history is that depressions are mostly debt and liquidity crises that are dealt with one way or another through easing of monetary policy, which changes over a period of time. I described monetary policy one, interest rates. Monetary policy two, buy financial assets, print money and buy financial assets. Monetary policy three, which we are in, is the printing of a lot of financial assets by the central bank and then buying government bonds to finance the deficit and getting money in the hands of those who wouldn't have had it through the normal financial system, essentially through that coordination. In all history, so when we go back to the 1800s and so on, there is that. And so the alleviation will happen in terms of that kind of ease. So when we think interest rates are going to hit zero and that therefore depressions last, no, they don't last, because in one form or another, and we're seeing it here today, that they will be the printing of money. Now, the value of money may not last, or they could be depreciated, but in the end, they always will ease, and you will have then that kind of reflation movement and that kind of change. So the hitting of a zero interest rate is not a hitting of a floor on the capacity of central banks to ease.
Beyond. If you paid attention to Dalio, it's clear that we've already hit 0% interest rates. This does not mean there's a floor to the power of central banking. The United States Federal Reserve is determined more than ever, along with the central banks of the entire world, to print their way out of debt. This might be a confusing concept to many. When we hear about these massive national debt piles totaling trillions and trillions of dollars, you may think to yourself how we as a country will ever pay that off. The truth of the matter is that those monster debt numbers are never meant to be paid off. You can hear Dr. Sven Carlin explain it here.
The environment is such that there is not enough income to finance the debt burdens. So the only solution is or default. Nobody's going to default. Nobody wants to default. So the other solution is simply to print money as much as you can print and even trigger inflation to ease the servicing of the debt. When you see such big debts, 22 trillion, then people think, when are they going to repay it? Never. Debt is not there to be repaid. It's not like you going to the bank and you have to repay your debt. Governments, corporations, their intention is to never repay the debt. Keep that in mind whenever you hear about big debt piles.
We hear about inflation a lot these days, and overall we know it as an economic term that refers to an environment of generally rising prices of goods and services within a particular economy. As general prices rise, the purchasing power of consumers decreases. For an example, in 1968, a brand new Ford Mustang GT cost right around $3,000. You may think, wow, what a steal. But you have to consider that in 1968, minimum wage was $1.60 an hour. This means adjusted for inflation, that same 1968 Mustang would have cost $22,100 in 2020. So what does this all mean for governments? Well, here is a good example. If you're a government with a large amount of debt, inflation can actually help you. Let's say you find yourself as the leader of a country and you decide that printing $10 billion to finance some projects is a good idea. You sell bonds in order to raise this $10 billion, which you have a pay date on due 10 years in the future. Things are not looking good 5 years in, so you decide, along with the help of your central bank, that inflating the currency is actually a good idea. No worries about the people and their savings. Besides, who saves anything these days? Now, 5 years from now, you can pay every single one of those bondholders with your foreign reserves, converting them into your worthless currency. What you just did is inflate the debt away. All that borrowed money is worth way less in that 10-year time span, while your foreign reserves appreciate in value compared to your very own. This is not something that's talked about a lot, but it's actually a giant catalyst to many historic world-altering events. Hyperinflation in Germany actually led to World War I. We see similar conflicts emerge in other states like Venezuela, Lebanon, the former Yugoslavia, and countless other examples. If a government takes inflation too far, it can and will ignite conflict and regime change. Too little, and it'll never pay back its debts. The same situation can work for you as a citizen. Take, for example, someone living on the coast of Croatia in the former Yugoslavia in 1989.
So, dealing with uncertainty, whatever happens, I'll be alright, you have to say. Don't be a victim. Now on the investing stories for investing motivation. So my parents built a house in 1985. They took a mortgage, signed a mortgage, which was 50% of my father's salary from 1985 to 2017. It was 32 years of mortgage. My father said he wrote his death sentence. He signed his death sentence. But a few years later, the bank called in if they can repay the whole mortgage. So 27 years to go, 28 years left with one go. And they paid 135 Swiss francs, so that's about $135 for the whole mortgage. That's hyperinflation on a fixed loan. So that's what's going on now. A lot of money printing, inflation. So again, an opportunity to build something and then also take advantage of the situation. The estimated returns for that is 100x, probably over 30 years. Then the war, my parents-in-law.
So if you didn't catch that, if you are diversified in stocks or a foreign currency, you can easily make inflation work for you with a fixed loan. As Sven explained, his parents took out a giant loan to purchase a house before hyperinflation kicked in. As the value of the currency fell off a cliff, paying it off with any sort of foreign reserve that maintained its value became effortless. They practically got a house for 1/10 of its cost, which in today's market may be worth as much as 10 times more. These are important notes to remember when considering the future. You have to choose great businesses that will survive the worst of times. Even small returns long-term may beat out fixed income yields, even cash, as the Federal Reserve continues to print more and more.
Simply flooded the system with money.
Yes, we did. That's another way to think about it. We did.
Where does it come from? Do you just print it?
We print it digitally. So we as a central bank, we have the ability to create money digitally, and we do that by buying treasury bills or bonds or other government guaranteed securities, and that actually increases the money supply. We also print actual currency, and we distribute that through the Federal Reserve Bank.
Thank you guys for watching. Please make sure you hit that subscribe button if you enjoyed, and also consider joining my Discord server. There's a link in the description.